you think that way, here's a list from Kotak, which is the Fab 15 as they call it. The Kotak Institutional Securities team has put out a list of 15 stocks which they believe can give you returns of 50 to 100% over the next 18 months. And they are liquid, large cap, reasonably large cap names, and not just penny stocks out there. Sanjeev Prasad of Kotak Institutional Equities, who is the author of that report, is with us now to take you through that. So Fab 15. Sanjeev, thanks for joining in. Let's start with the smallest piece of your Fab 15 report, a stock which is rarely discussed, Biocon. Why do you think that stock could potentially double from here?
So it just becomes so inexpensive, it's probably just fallen off in everybody's radar screen. At this point in time, people are just focused on the large caps. But if you see the valuation of the stock, it's come down to something like 7.5 times on March 2010 basis. What's happened over the last few months, it's been suffering from, I guess one is some amount of cost pressures because they have added to the professional team. But the order inflows have still not started in one of the contracts, and that's been ramped up in 2010. The second thing is clearly they have forest-related issues, so that is dampening the fiscal 2009 numbers significantly. So people are just looking at this, some of these one-off events and probably extrapolating these in perpetuity. So if you look at how much the stock has fallen, I don't recollect the exact numbers on the peak, but it could be anywhere from 80 to 85%, I would think. So it just become a very, very inexpensive stock at this point of time.
Sanjeev, hi. The only problem with Biocon is that the stock performance has not been great. I mean, even in the bull market era, it wasn't your best performing pharmaceutical stock, but you feel that you can see 50 to, whatever percent returns on the stock price?
We are looking at about 235 as the fair value for the company on 011 numbers. That is whenever the market starts discounting 011 numbers, maybe 15 to 18 months down the line. And our multiples aren't that great. We are looking at about 10 to 12 times multiples for various segments which they operate in. So it's not as if you're building some crazy multiples and trying to con people into invest in the stock. So it's a decent company and just fallen on a little bit of, I would say, hard time just based on one-off events which I think will change in 010 and definitely in 011.
Okay, the other one you've got in your list is a brokerage stock, India Infoline. Tell me why you like that story and why you think it's a fab buy.
No, clearly, going forward, we think the market will rebound from where we are in, say, 1.5 years' time. And if that be the case, clearly your broking volumes also pick up, because keep in mind the fact that there's a very strong correlation between the market and broking volumes. And if that be the case, then clearly India Infoline will benefit, because at this point in time, I don't think people are really building in any great increase in volume numbers going forward. And if you see our own numbers, we have been pretty conservative. We're looking at a decline in 010 and building a small growth in 011. So I think, if anything, these numbers will surprise on the upside as far as the market volumes are concerned, and India Infoline will definitely participate in that.
Let's talk about two infrastructure plays which you have picked. In Reliance Infra, which has been a big underperformer, and JP Associates. Why do you think these two can go on to deliver superior than market returns in the next 18 months?
Reliance Infrastructure, I think, is suffering from issues about the use of cash, because on paper, if you see, the company is sitting on about almost 10,000 crores of cash, but there is some bit of uncertainty as to where the cash exactly, because the management has not been very forthcoming on that. There is something like about 5,100 crores of ICDs which has been given to parties whose names have not been disclosed. But as I understand, the company has said to analysts that about 30 billion rupees or 3,000 crores of that has come in the fourth quarter. So hopefully we'll get some clarity in the fourth quarter results. So once at least people start getting some assurance that the cash has not disappeared or been put to some other use, I think you will start seeing some confidence coming back into the company, because all said and done, if you just value the cash on books of Reliance Infrastructure and take Reliance Power for at the current market price, you're probably looking at a far higher value than where the stock is currently trading. So effectively, you're not giving any value for the power generation business of the company, and even the infrastructure side, which they're getting into a big way. I guess the same thing holds for JPA. Again, there have been corporate governance issues with that company, but keep in mind the fact that the volume numbers, at least on cement side, are going to ramp up quite significantly. Power projects, they have been very good operators as far as the hydropower project is concerned, and once they start ramping up the projects, you will also start seeing a lot of construction-related revenues coming in. And finally, the real estate part, which is increasingly going to become a bigger portion of the of the overall sum of the parts. At least they seem to be doing the right things, and if you look at the projects they have launched in the Noida, Greater Noida area, the initial feedback and the initial response to the projects have been very good, and if they get the cash flows going in that business, that can support, a lot of growth in the other businesses also, because keep in mind the cement volumes when they ramp up to full capacity, that will start throwing a lot of cash to fund the power business, which in turn will lead to revenues as far as the construction business is concerned.
What you do have in your Fab 15, Sanjeev, is a huge chunk of commodity stocks. Let me start with the biggest one, because Tata Steel would be part of a list of commodity stocks you think would outperform considerably. I mean, I've heard about Sterlite and Hindustan Zinc, but not Tata Steel.
Again, at this point in time, steel is one of the commodities which is suffering probably the most compared to the other base metals. I think, again, if you are building on some sort of recovery as far as the global economic environment is concerned, again you will start seeing steel demand starting to come back, and keep in mind the fact that ultimately the stock has become very, very inexpensive. I mean, if you're looking at about 55 rupees EPS for next year, that's what we're looking at. It's trading at what, less than 4 times now on pretty depressed steel prices. So how much do you want to beat down that company? Yes, there are issues in terms of choruses, debt and all those things, but at least even in a quarter like the fourth quarter of last year, where they had volume issues and pricing issues, the chorus was still profitable and reasonably profitable. Tata Steel by itself is a very, very super efficient company as far as steel business is concerned. So if there is any turnaround in the business, I think the operating leverage which you will see in this kind of business is tremendous, and given the cost of operating Tata Steel, in fact on the bottom line is quite significant. We have shown some sensitivity in the report in terms of how much very small increases in steel prices, the impact it has on the bottom line of this company. So just a very, very highly leveraged play to steel prices.
Okay, let's talk about another stock which we don't discuss very often. United Phosphorus. Why is it in your list?
Again, it's a stock which has fallen off the radar screen of many people just because of focus on large caps. We think the fair value of this company in a year's time could be more like 140, 150 rupees. It's again a very, very efficient company, very well managed, and in this kind of environment we are not seeing any demand slackening for this product at least. It's just a case of maybe derating which has happened in the company for really no reason. As far as demand for agro products are concerned, they will continue, I think, for a fairly long time. I don't think any time the world is going to see a decline in agrochemical demand just because whatever is happening in the banking space or in case of economic slowdown. So as long as you see the numbers coming, people get confidence that earning numbers are there, there would be a re-rating of multiples in this case, and that's in general what we are arguing for most of the commodity stocks. They have got derated very significantly because of concerns on earnings in terms related to margin and pricing pressures. But I think that's a wrong way to look at commodity stocks. I mean, you can't have earnings of getting compressed and multiples also getting smashed at the same time. This is classical reversal of what was happening in the second half of 2007, when margins were expanding, but then people were also willing to give all sorts of crazy multiples on those very high margins. So the right way to look at commodity stocks is if the margins are below your mid-cycle or normalized levels, give a higher multiple. If the margins are above the mid-cycle or normalized margin levels, give a lower multiple. And I think the market is probably doing a reverse of what should be the logical way of looking at the stocks.